what is the most effective way to use technical analysis, which we all know is very important in trading? What would you say is the most effective way to use that in the crypto markets?
Well, there's so many ways to do it, quite frankly, but I think it's all about having an understanding of the supply and demand for the cryptocurrency space. Right now we're in a bit of a bear market cycle, and that goes for not just cryptocurrencies, of course, but for risk assets more broadly. And the charts can tell you that. There's very simple momentum indicators, tools that will remind us what side of the market we want to be on at any given time over multiple time frames. So I think it's key to have a sense of what the momentum is, short term, intermediate term, and long term, and also to have an eye toward key levels that we've seen support come into play before, meaning buyers stepped in, or resistance came into play before. It also makes sense to have a gauge of moving averages, where those moving averages that can at times become resistance or support of their own. We always are very respectful of any breakouts or breakdowns that occur, and of course we've seen more breakdowns and breakouts of late.
Oh, yes. And it is important to note those things when trading in the market. And I know some people who are new to the market who don't understand that there is a lot of nuance to it. So that's great to hear from you as far as momentum, moving averages, all those things. But let's discuss the two biggest markets, Bitcoin and Ethereum. What trends are you starting to see in both markets?
We've been seeing downtrends really across the board in cryptocurrencies and risk assets, as mentioned, and those downtrends, they're long-term in nature at this point. They've been intact year to date and longer in some cases, and that's certainly the case for Bitcoin and Ether. We are being respectful of those long-term downtrends, which still do exhibit downside momentum. That's growing. It's not improving to any great degree as of yet. We do have some stabilization that's unfolded recently over the past few weeks, and that's helped to preserve some longer-term support levels, and that can get us into a place where we might see some kind of relief rally. But for now, the consolidation phase that's had its hold for several weeks still has its hold. So we're watching for some kind of catalyst, a move out of that consolidation phase one way or the other to really assert a more directional short-term bias within the context of that long-term downtrend. Naturally, if it's a positive sort of catalyst that we see, that would suggest that Bitcoin and Ether can move higher within their downtrends, but to emphasize within their downtrends, counter-trend positions are always higher risk, and they're harder to take advantage of because they often occur pretty fast and furiously. We also like to watch the relationship between the cryptocurrencies, Bitcoin and Ether especially, because we feel we can get a sense of whether it's a risk-on environment or risk-off. And as you'd imagine, we've had a bit of a risk-off environment of late. And in risk-off environments, we tend to see Bitcoin outperforming Ether. And that was the case really since the August peak in the equity market. So it's something we were sort of tuned into, where Bitcoin started to outperform. That meant that risk was off at the time. And we're starting to see some early indications that we could move back into a short-term sort of risk-on environment based on that ratio between Bitcoin to Ether. The ratio itself had seen a really good relief rally and now seems to be losing that upside momentum, meaning that Ether could kind of have a turn here and outperform if indeed we see them clear the upper boundaries of their consolidation phases in absolute terms.
And thank you for walking us through that chart and seeing the comparison between Bitcoin and Ethereum. What is one of the major things that you see as a difference between trading the crypto markets versus more traditional markets? Is it, a little bit harder, a little bit more volatile? What are you seeing?
Well, certainly more volatile, and that does make it harder, I guess, by its nature. But we have indicators that are designed to reduce noise and to kind of smooth out the trends over the various time frames. So we value those indicators, I'd say, even more in a highly volatile type of environment. So the volatility does make it more difficult, but with more risk, you take on potentially more reward. So we understand that there's good interest in, well, when is this going to be a long-term bottom? And the levels that we watch, support, resistance, they've been really very reliable, we feel. For example, Bitcoin had a long-term support level around 18,300, and that's been tested successfully numerous times, so that gives us more confidence in the level. These levels tend to hold sort of a lot of reliability in anything that trades with sort of deep global liquidity, and of course that would apply in this arena. It applies to commodities and FX more broadly, and to a lesser degree, equities.
Mhm. And with that trading, the saying goes, "Scared money doesn't make any money." So scared money doesn't do it. So you have to have that risk in order to get the reward. And when people are trading using technical analysis, what do you see are some of the most common mistakes you see amongst traders that may get them, a big loss in the market?
Yeah, I think it's just not having an eye towards risk management. And the simplest way to do that would be to establish a stop loss when you put on a long position. So just not to have an idea of the amount of risk you're willing to take means that you run the risk of riding a downtrend lower or living through a breakdown. So I think it's always about having defined sort of risk metrics when you put on some kind of trade, or when you're investing. And the way we do that is through the identification of key levels. In this case, it would be a support level below which we'd put that stop loss. It doesn't need to be an automated order, but an idea of where you can say, well, this isn't doing what I expected it to do. The momentum has deteriorated. So therein, risk is heightened, and I'm going to move to the sidelines until we have, that positive catalyst yet again.
Mhm. Yes, people, if you're listening, please use a stop loss. As someone who's been in the market long enough, seen some horror stories, people making trades, falling asleep, and waking up to all their money gone. You don't want that. So definitely use stop loss. That's like your car insurance, so to say, right? It's better if you have it. And what can users do to create that strategy where, of course, they have a stop loss, they're using momentum, moving averages. What can they do to basically use this strategy and avoid FOMO? Because FOMO is very strong amongst a lot of traders.
I think it's a systematic approach, which is what we take in our research. So we every week write up the space, and we look at the same indicators week over week. And while there are times at which it doesn't add any new information, that's okay too. We need to know when things are changing. That's the most important thing. It's the dynamic nature of these tools that we have at our disposal, and they're really very accessible these days. So anyone can access these tools on the charts online, and often for free even. So very accessible discipline. I would just approach it systematically. Make sure to go back to the same indicators, the same tools week after week or day after day, and then you'll get a more reliable sort of takeaway, and it will help take some of the emotion out of the trading, that sort of fear of missing out. You'll have a full, complete picture of what the supply-demand profile is for any cryptocurrency by tracking these indicators and tools on a daily basis.